What's going on with Canadian real estate? More specifically, what's happening here in the GTA and what can we expect in 2024 and beyond? Stick around as I share my thoughts.
It's set to be a cold winter for Canada's housing market.
Home prices in Canada's largest city fell last month as higher borrowing costs took a toll on affordability. And with the cost and scarcity of capital rising, the industry is holding back some development of new supply.
The number of newcomers we aim to welcome will stabilize at 500,000.
Well, inflation and high interest rates are also playing out in Canada's rental market. A new report says rental prices in Canada hit a new high for the sixth straight month.
Well, the Bank of Canada decided to hold interest rates unchanged at 5% for a third consecutive meeting today. The central bank kept the door open to further rate hikes, but markets are expecting that the next move will be lower.
The average Fed forecast now sees 3 rate cuts in 2024.
Welcome back. Thanks for watching. I'm Andy from Sweet Additions, where we help investors and homeowners create more housing and generate wealth. We really appreciate if you can hit the like button and please subscribe to this channel if you haven't done so already. Additionally, we have finalized the details for our comprehensive in-person training program covering the principles, strategies, and tactics as part of the Max 3 strategy. This will be held in person on the weekend of April the 27th and 28th of 2024. We'll share more info at the end of this video, and you can also check it out at sweetadditions.com/training. Okay, folks, it's been a while since I put out one of these videos, 8 months to be exact. Now, the overarching theme from that video was that one of the biggest reasons that could affect real estate is ultimately how long the central bank can keep rates elevated. Now, before I start, I will once again preface this by saying I'm not an economist. However, the issue is that you have professional economists out there with opposing views. And so that means as an investor, I need to ultimately decide for myself what information I'll take action on and what to ignore. Unfortunately, we don't have a free market right now, but rather one that's highly manipulated. So all I'm doing right now is sharing my opinion. Please do your own research and come to your own conclusions. Okay, so with that out of the way, let's look at the most recent real estate data for the GTA. In November, TRREB data shows that the average GTA home price have pretty much been flat year over year. The big number to note though is the number of new listings. So this is a big 16.5% jump. With this many more new listings, this is likely to cause more downward pressure on prices, especially in the condo market. Now, to figure out where we think real estate is headed in 2024 and beyond, I'm not going to start by looking at all the Canadian headlines. I'll get to that later. What I will start with is what I feel to be the single most important thing that will determine real estate in Canada. And that is, you guessed it, United States Treasury bonds.
Huh?
Okay, bear with me here. Many people think that Canada is an economic island when in fact our policies mirror much of the US fiscal and monetary policy. This is true for most Western nations such as UK, Australia, New Zealand, as well as Western Europe. So it makes sense for us to look at the US first for an understanding of the big picture. Something happened in November that sent shockwaves in the US bond market.
Interesting.
The US Treasury had a disastrous bond auction in November where they were unable to sell long duration bonds to the open market at the rate that they intended, but instead had to pay purchasers at a much higher rate than they anticipated. This meant that the prices of these bonds went down while the yields went up to attract buyers. What this signals is that the market sees the reckless spending and knows the US government is unable to fulfill its long-term obligations with its record debts and deficits. And it doesn't trust that in the long term, the US is going to be able to pay back its debts. And if they do, it will be in severely debased dollars. The US Treasury is relying on the sale of these bonds to keep the government running. And this kind of bond auction failure would likely be the norm in the coming months and years. Okay, so what does this have to do with real estate in Canada? Bear with me here. With fewer and fewer buyers of US debt, ultimately it means that the Federal Reserve will need to be the buyer of last resort, which means, you guessed it, more money printing and putting the government into further debt. Now, when we did our video back in April, US debt was less than 32 trillion and now it's almost 34 trillion. For the past year and a half, the central banks have been able to keep rates higher for one main reason. Many of the debts owed by the government have not matured, but in the next 12 to 24 months, the US government needs to roll over a lot of its maturing bonds. Interest payments alone in the US will soon surpass military spending at over $1 trillion annually. And sometime within the next year or two, it could mean that the Fed is done with quantitative tightening and back to quantitative easing, a fancy way of saying more money printing. As a matter of fact, the market is pricing in rate cuts this coming year as shown in the current bond market. The US government is broke. At the same time, spending is at an all-time high with lower tax receipts, a possible recession, and no one to lend them the money. Meaning, once again, the central bank will need to rescue them. Not doing so will mean a painful deleveraging and economic pain, so my opinion is that they would rather try to keep the economy propped up with more stimulus. So this is going to be in the form of lower interest rates or a lot of money printing or both. It still means that going forward, there will be more debt added to the system and continued inflation in the long run. All roads lead to one thing, which is more money printing. And ultimately, whatever policy the United States enacts, Canada and the rest of the Western world central banks will follow. So if the US Fed lowers rates and prints, Canada will likely do the same. And mathematically, it looks more and more like 2024 is shaping up to be a year of continued massive government spending on both sides of the border and excessive debt. So this is essentially what many economists call a debt spiral. More money printing leading to more debt, which leads to more money printing. And this will likely continue to drive asset prices up. Now, here in the GTA, property prices have already retracted 20 to 30% from its peak in early 2022. There's a lot of folks online suggesting it could go as low as 50%. That's possible, but I think it's unlikely. The money supply in the system cannot be taken back without causing serious damage, and we don't think the Bank of Canada will allow that to happen. Have a look at this chart which shows the M2 money supply in Canada, which reflects the credit growth. It has essentially grown 5 times since the year 2000. This makes sense, as a home that was worth, say, around $300K in the year 2000 is probably worth around $1.5 million today. For those that say that house prices need to drop by 50% to go back to a quote-unquote normal market, they need to also explain how the M2 money supply is going to get cut by 50% without a serious collapse of the current system. Okay, now that we got this crazy macroeconomic stuff out of the way, let's talk about some local factors that keep average home prices in Canada higher than our G7 counterparts. So these would include immigration and stalled home construction. In this Forbes article, it states that Canada's immigration target will remain unchanged in 2024 at 485,000, and it's set to increase to 500,000 in 2025 and 2026. And this figure doesn't include people who are here on student or work visas. For context, the United States let in 1.25 million people, which is 2.5 times the number of new people in Canada, but their population is almost 10 times that of Canada. Regardless of actual price, the sheer demand for housing will likely remain strong. Now to discuss the issue of new supply. It's probably not a big surprise to everyone that construction has slowed significantly due to the high cost of development, both because of the rapid rise in rates as well as the increased costs for materials and labor. In this CBC article, they highlight this with some figures. Here's a quote from the article. Compared to April 2020, when lockdowns shut down part of the development industry, investments in single-family homes is down 21%, the report says. Check out this chart from the National Bank showing the population increase versus the supply of new housing. This is insane. Anecdotally, I can tell you that new home construction have slowed, whether it's additional suites or new single-family homes. Many of my contacts in the development space has put a pause on projects until the numbers make more sense. Even for myself, I have a property that is ready for construction, but I'm putting it on hold due to the high cost of borrowing at this time. To add fuel to the fire, even if developers have the financial means to build, it's still very challenging to get a building permit with a lot of bottleneck at the municipal level. Without all the statistics, I can tell you from my personal experience that although provincial and municipal zoning policies have gotten better, getting building permits is still no walk in the park. According to the World Bank's Ease of Doing Business Index, Canada ranks 34th out of 35 OECD countries in the average time it takes to get regulatory approval for a construction project. All this is to say that we most likely will not hit our national target of 3.5 million houses by 2030. We don't have a crystal ball, but given all the factors we've outlined, it seems that the likelihood prices will remain elevated in the years to come have a higher probability than lower prices, and that's what my base case is. In the short term, can it correct further? Sure. But directionally, in the long run, it looks like continued inflation, more immigration, and a supply squeeze, meaning the current nominal value of house prices will likely remain high. Right now, sentiment in the housing market is at an all-time low, and we have prices correcting. There's no question about that. Remember, nothing goes up or down in a straight line. And listings have increased as there is a lot of distress selling in the market, likely a lot from over-leveraged investors jumping in when the market was at its peak from 2020 to early 2022. So this could be an interesting time for homeowners and investors who aren't over-leveraged, have cash, and willing to look longer term. This is because of the very likelihood of much more asset inflation to arrive in the coming years. Now, in the next year, rates may stay elevated and home prices may not bounce back quickly, but to me, it seems like there are signs that we could be in for another real estate bull market in the coming years. Now, if you get into the market now, the great thing is that even though rates are high, the prices have come down from the top, and so the down payment is much less, and there's a high likelihood that rates have peaked, so payments will be even lower in the future if and when rates eventually come down. Again, this is only my opinion based on my analysis of the big picture as well as local factors. If you're going to get into the market, you need to make sure you do everything you can to mitigate downside risk as much as possible. At the end of the day, whether or not you take action, you are making a decision, so you need to decide wisely. As I've previously stated over and over again, never ever be over leveraged. In our past video, we talked about 8 things you can do to maximize your upside potential while minimizing your downside risk. You can see that information in the description below. One additional thing I'd like to mention is the current social environment is very volatile. There's a lot of anti-landlord sentiment right now with rent strikes and policymakers pointing to investors as being the problem. Many people are angry because they cannot afford to buy a home and rent continually rises. Their anger and frustration is understandable, but often it's misguided. It's not the fault of investors who are the ones putting in the money, effort, and risk to provide more housing units in the market, but rather reckless fiscal policy with government spending and loose monetary policy, keeping interest rates low, and massive amounts of money printing in the past 2 decades. The current Landlord and Tenant Board, which is meant to be an unbiased entity to assist landlords and tenants, have been overwhelmed and unable to be a proper adjudicator, often with case hearings taking 6 months or more. And many professional tenants take advantage of this. So you have to navigate this more carefully than ever and not rely on the Landlord Tenant Board to provide a fair solution. There are things that you need to do to protect yourself. You may also want to consider diversifying a bit into real estate that is outside the jurisdiction of Ontario and perhaps even outside of Canada. The great thing is that the Max Street trend we are talking about is a shift happening across the country and in the US, so this strategy works in many different markets and jurisdictions. So ultimately, we feel that in the short term, it will be hard to say where the real estate is headed in 2024, but in our opinion, longer term, it looks to be a good asset to be in. Of course, we're referring to single family homes that you can forcibly add value to through additional suites. We don't know what's going to happen in the broader market, but at least we can insulate ourselves from big impacts by focusing on things within our control. And houses that can be converted to additional units, thereby increasing its value and cash flow potential, can help us even if the greater market goes in the other direction. If you agree with this view, then you might want to prepare accordingly for the next real estate cycle. And to mitigate your downside risk while maximizing your upside potential, you may want to consider implementing the Max Street strategy on your property portfolio. So this leads us to our in-person comprehensive training program on implementing the Max Street strategy, which is now finalized for next April. If you're interested, please go to suiteedition.com/training to apply, and we'll give you more details about this training. Okay, so this is all we have for you guys. Hopefully some of this information was helpful. Hope you have a wonderful holiday season, and best of luck for 2024. As always, thank you for watching, and we'll see you in the next video. To learn more about the Max Suite strategy, download our free guides at suiteeditions.com and get started. And if you enjoyed this video, here's another great one for you.